Welcome back to Big Deal, and we are with the top team of Advent International right here. So we were talking about the financial services space in particular and the focus of Advent International. But David, a lot of the financial services, fate going forward is also dependent on how the central banks act. And a huge bit of positivity is being penciled in because of the turn in the interest rate cycle that is really expected in the second half of this particular year. How do you see this? And from the US, what is the on-ground perspective that you have on this?
Well, I mean, once we got to the inflection point where people had confidence that interest rates had plateaued, that's a big sigh of relief for the financial markets in many ways. And so today there's obviously speculation in the US about how many cuts there'll be and when those cuts will happen. But more importantly, we've gotten to a healthy place where there are much lower concerns about growing inflation. And so with the guidelines for inflation in the sights, it certainly gave a much stronger signal for the environment for new investments, as well as from a lending standpoint, that we were going to be able to finance our transactions in a way that was suitable for the investment purposes.
Right. So, James, very critical for liquidity push across the world right now. How do you see it?
I totally agree with David. I mean, clarity on rates has been an essential factor, as you know, in terms of pricing risk, right? You need to know where those stand. I think in Europe, just to give a perspective on that, the full effects of these higher rates, I'm not sure has been completely felt through the system.
Yes.
And therefore, I would say there is still some vulnerability, both in the corporate side and on the individual side, the consumer side. But I think that now that we have more clarity that rates are not going up anymore, it certainly is a huge benefit in terms of pricing risk. And so we would have expect more deal liquidity generally in 2024 relative to 2023.
Right. So, Shweta, definitely this is a big relief that the market is really watching out for. But when we talk about the healthcare space, how are you positioned now? Of course, you're creating that large platform in the healthcare space, Cohance. But on the other hand, Serum is also on the block. So what is the dichotomy in this strategy? And has Serum, for you, really, had its own life cycle completed?
Yeah, so again, I won't comment on the exit point, but Nisha never gives up. So yeah, having said that, obviously we have a life cycle for investing, right? I mean, which is give or take between, pick a number between 3.5, 4 to 5 years, right? So when we invest in a business, even there doesn't mean that when 4 or 5 years ends, the opportunity in that company has ended, right? But for us, if we have the business has done well and we are making good money, there's no reason for us to continue, because our fiduciary responsibility is to deliver the goals that we have set for the company and exit and move on and do our next investment, right? So we will continue to do that and evaluate that for all our investments in India. So that doesn't mean that I'm less interested or more interested in a sector, right? Just because I exited Crompton Greaves doesn't mean I can't buy Eureka Forbes.
Right.
So it's just you have to continuously churn that. That's our business.
So more investments in healthcare is what you will look at right now. And which areas? Again, healthcare has become very large, and a lot of services side, diagnostics, hospitals, all of these are also doing extremely well now. So, and the maximum number of deals we've seen actually in the hospitals in the last year, and that really carries forward this year as well. So what is it in terms of risk rewards which looks attractive in healthcare?
So I would say, while hospitals is interesting, we did hospitals back in the day when many people now have jumped onto that bandwagon, I would say. It's a very interesting space from a macro standpoint, but unfortunately valuations have really run ahead of themselves there, right? So if you see the uptick in valuations in hospitals over the last 12, 24 months, it's been pretty crazy.
Right.
So it does make it a much tougher segment for us to look at. Having said that, if you find the right opportunity with the right valuation, I mean, we like the overall healthcare services space. Diagnostics, there's been some correction, but I would say not enough to kind of factor in the disruption in the market because of the number of new players, online players that have come in that market, right?
Right.
So we like the overall healthcare services space, but I would say we are cautious on the valuation front on that. But there are other areas like, medtech, retail pharmacy chains,
Yes.
which also continue to look interesting, just riding on the same sort of overall macro theme, right? Continue to like pharma, continue to like domestic formulations. We think it is an inherently secular growth market for the foreseeable future. So we will continue to evaluate deals in those spaces.
All right, so continue to be bullish on the healthcare space, but of course, high valuations is a concern for an investor. Now, David, this is cutting across sectors. It's not just healthcare, but anything to do with consumption in particular, also given our demography, has been commanding higher valuation, and investors have been complaining about it. What's your view on India consumption? Because last time I spoke to Advent, there was a little bit of disappointment on the demand side. It's not as per the expectation. How do you see the consumption theme for India, and has anything changed over the years?
Well, in a lot of markets, it's complicated. It's not always easy to simply look at consumption and or try to find the right businesses that are going to match those demands. And so in a lot of markets, we've had a bifurcated strategy where we've invested in premium and super premium type of products, and then deep discount in the same market.
Right.
And so I think as things evolve, it could be a similar formula for us here in India. So we've invested in things like Lululemon and Zimmermann and some of those products that are beginning to get traction in this market. But we also did extremely well investing in dollar stores and value discount businesses.
Right.
And so I think as the consumer continues to grow and expand here, we're going to find a number of opportunities. And I'll give you an example. I was having lunch yesterday with the CEO of Eureka Forbes, and I was asking him about some of the products and what were performing well. And it was really interesting to hear that some of the best performing products were the premium ones that were new innovation that had come to the market. So it certainly gave a lot of encouragement that while you might not have expected that, given some of the headwinds and the challenges that you mentioned, that we're seeing that demand for premium products and great brands in this market. So that certainly gives us more comfort that we can use some of the similar playbooks that we've used in other markets around the world as the Indian market continues to evolve.
Shweta, you spoke about the valuations. Now, when we talk about the private market valuation and public market valuation, there is a huge gap. There's a huge difference between the two. Is that really stopping the conversion of deals? And how do you foresee 2024 in terms of also making investments and entry?
Yeah. The good or the bad thing about the Indian market is valuations were high, are high, will remain high. So I think the arbitrage reduces, arbitrage increases. I think we've seen this cycle several times over in the last at least 23 years I've been in private equity, right? And again, I go back to the style of investing that we have, which is really bottom up, find the right opportunity. What can we do with the company, even if I'm overpaying for it, which for most part we need to. What is it in the Advent's hands with our toolkit that can make this business a better business at exit, right? And you can probably get a premium to the valuation you paid as opposed to even have to look at a discount to that.
Right.
But that's what we look at. I feel, yes, public market valuations are high, and that tends to have a trickle-down effect on private market valuations as well. But we just have to find the right businesses, I feel.
Right. And just a word also on technology. How are you positioned in terms of technology investments, and which is the pocket that you really like? There's traditional IT services, and there are many new areas which have developed. We went to digital and now artificial intelligence. What would be your focus?
So, I think in the much newer areas, again, we struggle, at least in the Indian context, because there isn't much scale. So, if you look at SaaS companies or whatever we evaluated, we just haven't found enough scale. So, I think for us, it'll probably not be at the two ends of the spectrum, which is sort of very new age, very young, many Gen AI focused companies, or the very traditional IT. I think we'll have to find our niches like we have, right? Like an analytics business that we invested behind, which is Trident, right?
Yes.
Or the digital product engineering services company like Encora, right? So we are finding spots which kind of play into future themes
Right.
and can be sort of good providers of services to those themes, as opposed to investing more behind, younger product-led companies in the Indian context, because they are still quite young and small for us.
Thank you so much, James, David, as well as Shweta, for joining us. With that, it's a wrap on this edition of Big Deal. Thanks so much for tuning in.